Circle just had the worst day of its entire public history, down 20% in a single session, 5.6 billion in market value, erased. The reason? A single piece of proposed legislation that could rewire the entire stablecoin industry. Banks are winning, crypto is losing, and the ripple effects just started. On March 23rd, a revised draft of the Digital Asset Market Clarity Act leaked, known as the Clarity Act. It's the biggest piece of crypto legislation in US history. And the latest draft did something the crypto industry didn't see coming. It banned passive yield on stablecoins entirely. Here's how stablecoin rewards have worked until now. Circle issues USDC. It holds US treasuries as backing. Those treasuries earn interest. Circle shares that income with Coinbase. Coinbase passes it to users as rewards for holding USDC on the platform. That revenue sharing pipeline accounts for about 20% of Coinbase's total revenue. The new Clarity Act language prohibits anything economically equivalent to interest on stablecoin balances. Rewards are only allowed for activity, using the token for payments, trading, or lending. Holding gets nothing. Circle stock crashed 20%, the worst single day since its IPO. Coinbase dropped 10%. Mizuho analysts said the provision reduces the long-term attractiveness of USDC. Compass Point cut the price target. The market took the news as a win for banks and a direct hit to the crypto business model. Here's the context nobody is telling you. Banks have been fighting stablecoin yield since the Genius Act was passed last year. Their argument is simple. If crypto platforms can offer 4% on USDC, while banks pay 0.01%, trillions of dollars in deposits will flee the traditional banking system. Standard Chartered estimated that if stablecoin yields remain legal, up to $500 billion in deposits could migrate from banks to crypto platforms by 2028. That's not a prediction. That's an existential threat to the banking industry's core business model, taking cheap deposits and lending them out at higher rates. So banks deployed their lobbyists, and they won. The American Bankers Association got exactly the language they asked for. Senators Alsobrooks and Thom Tillis crafted the compromise. The final draft blocks the only feature that made stablecoins competitive with bank deposits. This is the story of how traditional finance defended its turf against crypto innovation, and nobody can believe the banks actually pulled it off. But here's the plot twist that makes this story insane. Tether, Circle's biggest rival, has never paid yield to USDT holders. They kept all the treasury income for themselves. For years, that made them look greedy compared to Circle's revenue-sharing model. Now the Clarity Act essentially bans what Circle was doing and changes nothing about how Tether operates. Tether quietly became the regulatory winner by being less generous the entire time. And on the exact same day Circle crashed, Tether announced it had hired a Big Four accounting firm to complete its first full independent audit. For years, Tether faced criticism for not providing formal audits. That reputational weakness was Circle's biggest marketing advantage. Now Tether is getting audited. Circle is getting regulated. And the gap between them just closed overnight. USDT dominates at 184 billion market cap versus USDC's 78 billion. That gap could widen from here. So who wins if Circle and Coinbase lose? First, traditional banks. 500 billion in deposit flight just got blocked. JP Morgan, Bank of America, Wells Fargo, all winners by default. Second, Tether. The biggest stablecoin on earth just got validated by regulation. It doesn't need to comply with and transparency it's finally pursuing. Third, Ripple's RLUSD. It was built for payments and settlement, not passive yield. Under the Clarity Act's activity-based carve-outs, RLUSD is effectively unaffected. It reached 1.25 billion in market cap within 15 months without ever offering yield. Now it has a regulatory moat. Fourth, MasterCard. They just acquired stablecoin startup BVNK for $1.8 billion. Traditional payments giants are building stablecoin rails inside the regulated perimeter. They don't need yield because they make money on transaction fees. The stablecoin industry isn't dying, it's reorganizing. And the winners are the ones who were never dependent on yield in the first place. So what's the chaos capital take? Circle at its current level is either a crisis or an opportunity. If the final Clarity Act language softens, or if Circle finds activity-based workarounds, the stock re-rates fast. If the bill passes as written, the business model needs rebuilding. Coinbase is the direct collateral damage. 20% of revenue is at risk. But Coinbase has derivatives, custody, and trading fees that reduce the dependency over time. The real trade is who benefits structurally. Banks win. Tether wins. Payment giants like MasterCard and Visa win. and stablecoin infrastructure plays that don't depend on yield, like Ripple, win. This is what happens when legacy finance meets crypto innovation. Banks don't innovate, they legislate, and they just proved they can still beat Silicon Valley in Washington. The capital markets are chaos. Embrace it, and I'll see you in the next video.